Hello, welcome. My name is David Stevenson. I'm from Doceo, and with me is Jasmine Yeo from the Ruffer Investment Company, co-manager of the Ruffer Investment Company.
Correct.
Where are you on at the moment in terms of your asset allocations and like equities, bonds, the major categories?
So about half of the portfolio is held for our view in the sort of short term that we think we're likely to see an equity market dislocation and probably recession in the near term. So what is that 50%? It's held across fixed income, so long and short dated government bonds, and also some derivative protection. So we think that will help us if we have an environment where bonds and equities potentially sell off together. We've also got quite a high allocation to cash, which allows us to be liquid and nimble if we do get a sell-off to take advantage of opportunities. So about half the portfolio pointing it in the sort of short-term cautious direction. We then got about 30% of the portfolio, which speaks to what we think is the biggest structural risk for investors over the sort of medium, longer term, that we are in quite a different environment today around inflation, which is probably on average going to be higher and more volatile. So for that, in that 30%, we've got index-linked bonds, so government bonds linked to the rate of inflation, and also some gold. And then the final part of the portfolio, sort of the third core theme, is 20% held across equities and commodities. So they are really the offset to those protective assets. What theme are in those equities? There's a little bit held in Chinese equities. That's with a view that if we're wrong about recession and you get stronger economic growth, we think that's quite difficult to happen without some positive news out of China. Risk premiums in China are a lot more attractive relative to the US. And then we've also got some commodities. So again, you're likely to see commodity prices perform better if global growth is stronger for longer.
And just sticking on the equities theme, a lot of people are very overexposed to America at the moment. You know, everybody talks about the Magnificent Seven, you know, and the whole kind of tech theme. I'm guessing that might not be front and foreground in your portfolio at the moment.
No, so there's some very small slice of it in the portfolio where we can get sort of more on board with some of those valuations. But no, our equities look pretty different to that. And because they're in the portfolio deliberately as an offset, fixed income and the bonds we've got in the portfolio will probably do well in an environment in which yields fall, which will be an environment in which that flavour of equity that you mentioned, tech, growth stocks, will probably do well as well. So we want the equity to deliberately point in a different direction. And to your point around valuations, risk premiums, again, what's on offer in the UK, Europe, China, from a valuation and risk premium perspective is a lot more attractive relative to the US, where you're really not being rewarded for taking on the additional equity risk relative to cash.
You've already mentioned the inflationary trends out there. There's these, I mean, Robert Shiller, the economist, talks a bit about narratives, doesn't he? And the big narratives out there, I suppose, is higher for longer. Although I sometimes like to distinguish between higher for longer and higher for much longer. And you can absolutely see that the central bankers may have been behind the curve in the last couple of years, and they felt the need to sort of, you know, hike up interest rates. And then you can think, well, we might have a recession. And then classically what people do in recession is they bring down interest rates. So you could argue that you could have higher for longer until, say, 2024, maybe at a push, beginning of 25. And then it's the higher for much longer argument, which says, oh, no, we're in a kind of new world order. Inflation's going to stay possibly above 4 or 5% consistently. And in fact, interest rates might need to stay above 5-6% for a while. Where do you form that debate?
So I think in the longer term, I think you're right. There's going to be a lot of policy volatility. And I think that will be in response to inflation volatility. So I think in the long run, what you're likely to see is interest rates held below the rate of inflation. So that what we would describe as an environment of financial repression. And we think that's likely both because it's very difficult, we think, for the economy to support or you know, sort of survive in this higher interest rate environment because of the huge amount of debt, sovereign debt to GDP ratios in developed markets sort of back to World War II levels. So
the UK's above 100%.
Exactly. So extremely high debt levels, we think, makes the economy pretty intolerant to higher interest rates. So I think they're unlikely to be at these levels for a prolonged period of time. And yet inflation, we think, is likely to be, on average, higher over the long run because I think we're in a more inflation-prone economy today relative to where we have been in previous decades. And that's because things like geopolitics being relatively calm and benign, globalization, favorable demographics drove an environment of very low and stable inflation. And as very obvious today, very sad sort of geopolitical events a lot of those things are now reversing. So that's the kind of structural view. I think thinking shorter term, perhaps more cyclically, tactically, our view is that the Fed are likely to hold interest rates high until something in asset prices or in equity markets breaks.
Yeah.
So currently markets are pricing about 100 basis points of interest rate cuts for 2024. We think that is only likely to happen if you get a correction in equity markets and or a recession. We think the Fed is likely to keep those rates high because firstly, inflation is still quite a long way from target. And as you mentioned, I think they're pretty desperate to restore reputation and credibility after having been quite slow on the sort of upward rate hiking cycle in response to inflation. So, what does that underpin, or what's been our view all year, is that central bankers are in a pretty difficult position. Because on the one hand, to stop things breaking in financial markets, they probably should be cutting interest rates as the market would like to see. But inflation is still high. And so to combat inflation, they need to keep interest rates pretty high. So they're kind of sort of stuck between a rock and a hard place. Ultimately, we think they will favour inflation fighting because of the reputational risk of not doing so. And that means that asset prices have to fall before we do get those interest rate cuts.
I suppose generally, if we think that interest rates are going to come down, we finally come to that turning point where bonds look a bit more interesting. I mean, they've had a terrible few years, and we're not talking indexing, we're talking conventional here.
Yeah.
They've had a terrible few years, obviously, because of increasing interest rates. Have we reached that tipping point where conventional bonds are beginning to look a little bit more attractive?
Yep, so we think so. It's something we've been adding to the portfolio as well. So we've been sort of slowly adding to duration all year, but made a more sort of decisive move in October.
Right.
And that included some purchases of 30-year nominal treasuries.
Okay.
So non-inflation.
So treasuries, yeah.
Yeah, absolutely. Are we calling the top in yields? No. At Ruffer, we never try to time financial markets, but do they look more attractive? Interest rates or yields are sort of 5%. And are we getting closer to the point of recession and closer to the point at which things are likely to break, given that yields are now sort of around, or if they've just come below 5%? Yes. So we have been buying them in the portfolio. They should provide powerful protection if our core view is correct. But even if that's not the case, you probably will see bonds perform potentially quite well in a soft landing scenario, given the starting point for yields and sort of the very sharp and fast increase in yields that we've had. That soft landing scenario, and you've seen that over the last couple of weeks, is likely to see bond yields come a bit lower as well.
But more treasuries or governments than corporates?
Yes, and that's really with a view that corporate credit, we still don't think is sort of reflecting the recessionary risks and the fact that interest rates. So actually in the portfolio, we've got credit protection. So effectively exposure to rising borrowing costs and widening credit spreads. And that's actually protection we've been adding to alongside the additions to duration, because in an environment where yields continue to rise and that duration hurts, so the purchase of those treasuries hurts if yields continue to rise, that protection probably does quite well, because as yields continue to go up, that continues to stress corporates and potentially you see credit spreads widen.
You've already mentioned geopolitics a couple of times. Geopolitics is always an interesting area, isn't it? A lot of people instinctively think geopolitics is very relevant to markets, and yet there's been plenty of studies that are done which suggest that geopolitics doesn't have much long-term impact at all. So it's one of those kind of, it's a bit marmitey. People think it's either very important, particularly in the moment with all the kind of terrible tragedies out there, and then other economists go, well, no, the long term doesn't matter. What's your take on it at the moment? Do you think investors should be concerned about the geopolitical risks?
I think it's going to be a key driver potentially of asset prices and also inflation over the longer run. So as I kind of referenced, I think one of the things that allowed such a long period of low and stable inflation was relative geopolitical peace. I think the fact that you've had US-China trade wars, as you mentioned, you now got a very tragic war in Europe. You've got the conflict in the Gaza Strip. We think over the long run that is likely to contribute to higher average inflation. For example, as countries, governments, companies want to trade with trusted sort of trading partners.
Onshoring, friendshoring.
Exactly. And that's really been sort of exacerbated by COVID and an awareness of how fragile.
End of hyperglobalization.
Yeah, exactly. Over the shorter term, I think what's been interesting over the last couple of weeks is you've seen a lot of that geopolitical risk premium come out of prices of gold and oil. So oil is now trading back to where it was pre-conflict on sort of the 7th of October. What that suggests to us is potentially the market has now priced a sort of a positive outcome, or not pricing the risk of an escalation. So potentially what that means is that if you do get escalation, there's sort of a vulnerability there around a spike in the oil price. You might see gold sort of increase in value.
And what proportion of your portfolio is gold at the moment?
It's about 5%.
Okay, quite small.
Yeah, so not huge. I think the interesting thing about oil, though, is if you did get escalation and an oil price spike, potentially that could tip us into the recessionary scenario a bit quicker, because for consumers, an increase in the oil price is effectively another tax on their spending.
Yeah, well, you've just brought the next question I was going to ask about recession. I mean, I think you've probably already answered this question already, because I think you've already given enough hints about it. But do you think a slowdown or recession is on its way in the UK and in the US and all developed world economies? Yeah,
so our sort of core view and our base case is that it's very difficult to see how we go from, in the case of the US, 9% inflation back towards their 2% target without any pain in the real economy. And it would be incredibly unusual, in fact, sort of unprecedented, if we managed to go from 0 to 5% interest rates without a recession. Sort of 70 years of empirical evidence suggests that when you get a rate hiking cycle of that magnitude, you do take the economy into recession. And ultimately, that's going to be what's required, we think, to bring inflation back down to target. You know, what we're not positioning for is sort of this soft landing and immaculate disinflation type scenario where inflation falls without any pain in the real economy. We would definitely acknowledge that the economic data is mixed. So, for example, in the US, the most recent GDP, the most recent GDP print was very strong. It was just shy of 5%. That is a sort of quite a noisy indicator and also a lagging indicator. When we look at the leading indicators, so parts of the labour market, like the breadth of job growth in the US, hiring rates, hours worked. When we look at credit conditions, so surveys like the SLOOS in the US.
Car loan defaults are going up.
Exactly. A lot of that is suggesting that the US economy is starting to weaken. Those interest rate hikes are starting to have an impact. And therefore, we think that recession is still the most likely scenario.
Is there any pockets of mainstream equities that you do think are interesting, that they're going to survive the impending, certainly slowdown, maybe a recession?
Yeah, so I think, I mentioned places like China, but also the UK and Europe, where the equity risk premium is a lot more attractive relative to the US. Yeah, so sort of the risk premium available in China is about 6.5. In sort of Europe, it's between 4 and 5. In the UK, it's about 6. So pretty attractive relative to the US. There are sort of, so you say, pockets of opportunity. Given our macro view, our equity weighting remains pretty low, because we think if we're right about the withdrawal of liquidity, a recession, there's probably going to be a better moment to buy some of those equity markets.
And on the China, we'll just put there one on that subject. I mean, you're not worried about the geopolitical risk of China? I mean, there's a pretty big geopolitical risk of China. Does that concern you?
Definitely, China is a bit of a black box. There's a lot of sort of challenges and problems there, and it's why I think on a medium and longer term view, there's a lot more sort of risks to consider. It's very much in the portfolio at the moment as a tactical allocation. In the case that you get some positive growth out of China, and that sort of pushes out the recessionary view.
One last question. You talk a lot about kind of asymmetric profiles in terms of returns and everything, and it strikes me that there's a lot of things where you could benefit, in a sense, from market volatility, and that makes you seem a bit more like a kind of hedge fund. So would you regard yourself as a hedge fund?
So we would describe Ruffer as a hedged fund rather than a hedge fund. So we do share some characteristics. We're unconstrained, we're global, we're unbenchmarked. But ultimately, what we're very different in terms of us versus a hedge fund is our focus, and our starting point is on capital preservation. So we always look at the risk to our investors of losing money. What are the dangers in markets? How might investors lose money? What are the risks? And only once we've found assets that we think will protect and make money against those risks do we start to look for the opportunities and how to deliver positive returns. That pretty much inverts how a hedge fund might approach things, where they're really sort of return maximizers. We're really sort of looking to minimize regret, and our focus is on capital preservation. The other thing is that we don't charge a performance fee, which most hedge funds do.
Rather big difference.
And the really important thing about that is around incentives. So we think if we were to charge a performance fee, that would incentivize us to try and deliver sort of short-term positive returns and chase returns and chase performance. That really flies in the face of the starting point for us, which is around capital preservation. The other difference, I would say, is that, again, in the portfolio, while we're comfortable identifying what the risks and opportunities may be, we try not to time them. So we're always building a portfolio of protective and opportunistic assets to allow us to try to be consistent in delivering those positive returns. So we're not pinpointing a sort of particular moment in time where we think a risk will occur. We don't leverage those positions. We're trying to create a portfolio that can deliver consistent positive returns regardless of what happens.
Great. Thank you very much, Jasmine.
Thank you.
Thank you.